Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to teach you about earnings management. And so earnings management is going to be something that's related to the accounting analysis that I was explaining in my previous episode. Accounting analysis is going to be the second step for doing a business analysis. And what we wanted to see is basically if management was manipulating the financial statements of a company or if they were looking normal. But most of the times, all of those manipulations that I taught you how to reveal on my previous episodes are going to be for doing something that's called earnings management. So what is this? Earnings management is going to be the intentional modification of earnings that is going to be leading to different numbers. So plain and simple, you are modifying your numbers to show different earnings. But a little thing here that is something I was explaining previously is that you can do it upwards or downwards. So you may want to show more earnings than the ones that you actually have, or you may want to show lower earnings than the ones you actually have. So why would firms do this? Why would they show more earnings or less earnings than the ones they really have? Basically because they want to make their financial statements be aligned with analysts' expectations. And so analysts' expectations are going to be very, very important when we're looking at the stock market. Because what you're going to see is that every company is going to have a number of analysts from the top banks in the world that are doing some predictions about how this company is going to perform. And when you have an analyst consensus, this is going to be what everyone is agreeing this company is going to earn. A recent example that you might think of is NVIDIA. So you have a lot of analysts that are saying NVIDIA is going to be earning this amount next quarter, or they're going to have this different earnings throughout the year. All of these analysts are going to be estimating what is going to happen, and most companies are going to try to meet all of these targets for different reasons, for compensation, for their different incentives inside the organization, but mostly to maintain their company's price in the stock market. So why is this so important? What happens if a company doesn't meet the analyst expectations or the analyst consensus? It is going to be a very, very bad sign because internally you can do some adjustments, which is what I've been trying to explain over this past episodes. Management can change things to look good or to look bad. And so if a company didn't meet the target, you can assume that even with all of their makeup on their financial statements and everything that they did to show themselves as good, it wasn't enough. That's why it's a bad sign. It's not really because they didn't meet it, but because since you can do all of these modifications that are showing the company even better, and you still can't meet your target, it means that the company is not performing very good or not as expected. This is going to be the reason why most companies are going to be doing a little bit of earnings management. But so, I told you at the beginning that companies might also want to do earnings management downwards. So what if the market is estimating that I will earn, I'm going to put plain numbers, $1, and I'm going to have earnings of $2. Why can't I just show the world how good I am? Well, if you show that you did $2 instead of just $1, this is going to be a little bit of tying a rope in your neck because next quarter, the market is going to be expecting you to again double your earnings or double your growth, or they're going to keep expecting this high performance. So companies usually don't really want to show that they are overperforming as much because this is going to really hurt them in the long term. And this is something that happened For example, to NVIDIA that I was just mentioning. They did huge overperformance, and we can assume that probably they were even hiding a little bit. But so now the expectations are crazy because all of the analysts are creating this consensus of ginormous growth that may or may not be met, but what we know for sure is that it's putting a lot of pressure into this company. Companies usually want to be very, very close to their target. And if you can see a company that's following all of this consensus and it's getting close to their target, we know that this is a very stable company. If they can't reach their earnings, so they're below this expectations or above this expectations, we can assume that they were trying to do some earnings management, but again, it wasn't enough or something didn't go as planned. This is going to be the reason why some of the firms are doing it, but we're going to also have some strategies for firms to do it. There are basically 3 big strategies that companies may use. The first one is going to be called a big bath. This is going to happen most of the times when companies know that they're already having a bad year or a bad quarter. If you know that something bad is coming and you're going to be underperforming, sometimes companies prefer being very bad. And so being very bad in one term is going to allow you to be better in the other one. If you already know things aren't going well, it's better to have a big bath. And that's why it's the name. And what happens is that most of the times companies are going to create this large write-off or report significant losses all at once during a bad year. And so they're going to have this bad time only once, and then probably for the next terms, it's going to be better. But this is one of the strategies that is used for earnings management. The second strategy that is popular is going to be called the cookie jar strategy. And this means that you're setting aside some reserves or basically inflating expenses during profitable periods to boost earnings in less profitable times. So this one is not going to be getting into any of the extremes, but rather the opposite. You want to stay on the similar and consistent path. If you have less profitable times, you're going to try and boost them a little bit. If you have very profitable periods, you're going to try to lower them by generating higher expenses. This is going to be what's called the cookie jar. And this one is also a very common one for companies that are very stable in their consensus and their earnings. And the third common strategy that you might find is going to be called the bump up. This one is going to be timing or inflating revenue recognition to show stronger earnings in the short term. And this is often to meet expectations. But again, what we know is that this may have an implication in the next terms, because if you're boosting all of this earnings in the short term, it means that you can show them in the next terms. And what do I mean by bump up? Or, for example, by inflating the revenue recognition? As I was explaining earlier in my previous episode, there are going to be different accounting practices that you can do, such as when do you recognize revenue? For example, all of the tech firms are going to have deferred revenue that I was talking about. So it is different to sell a license, for example, today for someone that can be using it throughout the year. When do you recognize this revenue is basically part of management's decision. But if you're bumping it up, I may decide, for example, to show in this quarter all of the subscriptions that I got in this quarter. But that means that next quarter, I'm not going to have the money shown from all of the people that are still using my service. So this is going to be something that sometimes happens, but when you have a bump up or you're timing this to show very good terms or very good profits, this is going to be affecting you in the future.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Go further with the American Express Business Gold Card. Earn 3 times membership rewards points on flights and prepaid hotels when you book through AmexTravel.com. Whether your destination is a business conference or a client meeting, your purchases will help you earn more points for future trips. Experience more on your travels with Amex Business Gold. Terms apply. Learn more at americanexpress.com/business-gold. Amex Business Gold Card. Built for business by American Express.
And so there are basically 2 ways to detect earnings management. One is going to be quantitatively and the other one qualitatively. So quantitatively is going to be if you find discretionary accruals or if you're going to find distortions that are appearing, but qualitatively, and here's where I'm going to be focusing more on, is going to be the distortions on the income statement, because every time that you modify something in the income statement, this is going to leave an imprint on the balance sheet. So you can start comparing this to, remember on my last episode, I told you cash flows is very hard to distort. So that one's going to stay in another part. But the distortions that you're going to find are going to be in the income statement and on the balance sheet. Because if you have an overstated income, I'm saying that I earned more, this term, for example, this is going to appear in an overstated equity, and therefore on an overstated asset. Because remember, always assets equals liability plus equity. So if something is going to be changing in the income, this is going to modify the equity, and therefore it's going to modify everything else. So one little change is going to be seen in the rest. And so how can you identify distortions, and more specifically asset distortions, because these ones are the ones that we will always see, because you have to balance them out with the equity. So for asset distortions, most of the times, I'm generalizing, but most of the times you will find the distortions on 4 elements: receivables, inventory, fixed assets, or intangibles. So let's look at those. In receivables, firms may use the interpretations of revenue recognition rules, such as the ones that I was saying, related to performance, measure, or collectibility of the money. So in accounts receivables is where usually you will find some distortions that are related to this revenue recognition part. Second element is going to, so why do we have to look for this one? Because inventory may be overstated when impairment charges are not taken. And so this is going to be crucial when the style and the obsolescence are critical. So for example, in hardware firms or in fashion industry, all of this inventory is going to be highly important, because when impairment charges are not taken, this is going to show an overstated inventory that may boost then the revenue. The third element that you should be looking out for is going to be the fixed assets, because the fixed assets can be distorted with an ongoing basis, and this is going to be basically having differences or changes in the depreciation, but it can also be episodic. So if you have any impairments on this fixed assets, is going to be a way of distorting this asset. And lastly, the fourth element that you can distort are going to be intangibles, because firms are usually not allowed to capitalize on R&D or advertising. So all of these intangible things that are contributing to their profit and their ultimate bottom line revenue are not going to be allowed to be capitalized. So you have to be looking out for intangibles, because this is going to be something that companies might also change. So again, I'll summarize the 4: receivables, inventory, fixed assets, or intangibles. If you see that there's any distortion in any of them, most likely there was earnings management, because any distortion in any of them is going to imply a distortion in equity, which is going to imply a distortion in the income statement. So if you find one of these ones, you're going to know that a company was changing the statements in order to meet the analyst consensus. And again, this is not illegal. This is something that companies are doing all of the time, but it's something that you should consider because this small changes that I'm telling you will have an impact in the statements today, but also in the future statements. Because if a company is putting makeup on their financial statements to show a better face, it will show a worse face when we remove that makeup in the next terms. Or the opposite, if a company is doing a big bet that's showing itself very, very bad today, most likely it might be preparing for a future boost of their revenue or their income. If you like this episode, please share it with a friend so we can keep spreading the knowledge and they can learn more MBA concepts. And also, if you like it, tell me in the comments or give me a review because this motivates me and it helps the podcast tremendously. I'll see you in my next episode to understand more about financial analysis.